All right, want to also talk about the market because definitely on the rise today. We've got quite a rally underway. For more on the markets, let's bring in Marc Faber. He's editor of the Gloom, Boom, and Doom report. Marc accurately called the crash in '87, the tech downturn in 2000, and the market bottom in March of 2009. He joins us from our Sao Paulo bureau. Marc, good to have you back with us. Everybody's always interested in what you have to say. You did talk with us that we could see a bit of a rally. Is this the rally that you were expecting?
Yes, we had a rally from the low on the 9th of August at 1,101 on the S&P to almost 1,200. And then we came right down again. And basically, we didn't make new lows. And now I think that we can rally again for a while.
All right, so rally for a while. How long and how far in your view? We're what, at 11:58? You know I'm going to pin you down here
10 minutes.
10 minutes?
10 minutes.
Really?
No. What I mean is, I think a lot of people will say the market formed a double low, and we have some technical indicators that are going to turn positive, and so we could rally to around 1250. But as I said before, for me, we've reached a high on the 2nd of May, 2011, 1370 on the S&P. That we will not go through.
You have no doubt about that we won't go through 1370, even though
Well, no doubt. No doubt. Nobody knows for sure. But my view is, you see, you have a lot of people, the strategists that are very bullish. They have a year-end target of around 1,400, 1,450 on the S&P.
Okay.
Then you have the super bear. And I think maybe both camps will be disappointed. And we have a trading range somewhere between the July 2010 low at 1,010 on the S&P and a high of around 1250.
Marc, hang on a sec. I got to take this commercial break. More with Marc Faber in a moment.
Marc, you were just telling Carol that you see us trading within a range, not meeting expectations, I should say, disappointing the super bears and also the super bulls. I wonder why you think that the bears will be disappointed. Why won't we come back down again to the lows that we hit, say, in 2009 if we get another recession here in the U.S. and we don't get any help from the German economy, we don't get any help from the Chinese economy, basically the whole world coming down?
Yes, I agree with you. I mean, on fundamentals, one could make the case that we would go lower to, say, around the March 2009 lows at 666 on the S&P. But I think we have to be realistic that if the market dropped here another 10–15%, there would be for sure another quantitative easing move and other measures taken to kind of support asset prices.
Let me ask you on that note, I mean, everybody looking forward to the Jackson Hole meeting on Friday, and most people are saying, hey, we're rallying because of what we expect from Ben Bernanke, even though we don't expect anything from Ben Bernanke. I mean, a lot of people are saying he has no bullets left. The most he can do is just throw his gun. So, you know, what do we hear on Friday, and do you see maybe a sell-off in treasuries after that?
I think what he will say is that they are monitoring the situation and that they will take, in quotation marks, appropriate measures when they are required. And I'd just like to mention, to some extent, we are in midst of QE3 already, because by announcing that the Fed will keep zero interest rates until the middle of 2013, they basically encourage financial institutions to borrow short term and to buy 10-year treasuries.
Hey, Marc, I know, and I say this sarcastically, I know you're a big fan of Ben Bernanke's. I know you're a big fan of Alan Greenspan. Alan Greenspan was recently talking at an event. I want to read to everybody and to you, Marc, what he said. He says he is less worried about a double dip than most people are, but I'll certainly grant that the odds are rising, referring to the chance that the U.S. economy will return to recession. He says the reason we are so sluggish is the level of uncertainty. So some might say, yeah, we get that. There is a lot of uncertainty out there at this point. I mean, Marc, when you look around at things, you don't see any of that clearing, whether it's the European uncertainty, whether it's the uncertainty about U.S. growth here or about the U.S. fiscal situation. None of that's going to clear itself up overnight, is it?
Well, but what I see extremely well is that the stock market has traced out kind of a major high between November of last year and June of this year, and then fell very sharply with very strong momentum and conviction very rapidly by close to 20%. And I think that's a very important signal that we shouldn't overlook. I think new highs are practically out of the question for the next 6 months to 1 year. And we will likely move lower, but as I said, I don't think that we will have a complete collapse.
I just wonder why, you know, I mean, there's enough gloom and doom out there beyond the uncertainty. Look at the fact that there's no aggregate demand. The government is regulating so many different businesses out of existence, right? I mean, our spending continues to rise. We can't get any more revenue. I mean, unemployment is 20% across the country. There's so much gloom and doom out there. Why not be more bearish, especially you?
I agree with you. I'm the greatest bear on earth. But if you compare treasury bond yields and equities, then equities look reasonably attractive. I think we will have zero and below zero interest rates for the next 10 years in real terms. In other words, inflation adjusted. To keep money in cash is a disaster for the next 10 years. And finally, the mood is so negative right now. As a contrarian, you don't take a huge short position when people are as bearish as they are now and when insider buying has picked up as much. But believe me, I'm as bearish as the greatest bear is. It's just that I don't believe that stocks will implode.
Hey, let me ask you about that insider buying, Mark, because you're right. It's the most that we've seen since the 5 days ending March 9th, 2009. You know that date. That was the market bottom. I mean, so could that essentially be kind of a bullish sign here that things are bottoming out and that we could see, you talk about a rally, but could we see actually a very significant rally?
Well, I mean, the insider buying has picked up, but there is still a lot of insider selling, and compared to all the selling that has happened in the last 6 months, the buying is relatively muted. But still, the insiders in general are a group of people against whom I wouldn't bet necessarily. All I'm saying is I'm very bearish. I think we will have inflation. I think the treasury market is a disaster waiting to happen. I think the economy will slow down. They're going to print money. And we will go to war at some stage somewhere. And so you're probably better off in equities than in bonds. But my favorite investment remains gold. As it happens, the gold price is coming down, and I hope it will drop $100 or $200. It's not necessarily a prediction, but I think we will go down in a correction because there has been a little bit too much enthusiasm recently.
What about other commodities here, Mark? One of my favorite bears is Gary Schilling. He is betting against copper and a slew of other commodities that the global growth would normally drive the price of up. He thinks they're going to come down. But then you mentioned inflation. So what's your take on the other commodities?
Well, I've known Gary since 1970 when we worked together at White Wealth. And he's been a frequent bear about commodities and about copper. I happen to also think that copper is likely to come down, but I wouldn't bet too heavily on it because it takes a long time to bring on additional copper mines, and unless the Chinese economy collapses, the demand of copper will stay relatively high. But if the Chinese economy collapses and Jim Chanos is right, then you want to be short not only copper, you want to be short everything.
Hey, Mark, I've got a viewer writing in, and he said, you know, you said the 10-year would not go below 208. Where do you think the 10-year is going to go here?
And does he get Rosenberg a bottle
I
of
lost
whiskey?
that bet on a temporary basis. But I'd just like to also remind you that the 10 years made a new low, and David Rosenberg was right and I was wrong. But the 30 years hasn't made a new low.
Right.
The low in December 2008 was 2.53%. And now we're around 3.4%. So basically, we have an artificial market. The Fed has said, okay, we guarantee next to zero interest rates for the next 2 years. And so banks and financial institutions have piled into the 10 years because there's low risk at the present time.
Did you get Rosenberg that bottle of whiskey?
The first bet expired and I won it. That was last June. The second bet extends to June of next year. So next year in June, I may have to give him a bottle of whiskey.
Got some time there, though, that's for sure. We'll see what happens. Hey, Marc, thank you so much. Marc Faber joining us there.